Ladies and gentlemen, welcome to Malaysia Construction Mid-Year Market Update. We will begin the session in 2 minutes. Thank you. Good afternoon, ladies and gentlemen. Welcome to Malaysia Construction Mid-Year Market Update. We are delighted to have you with us today. My name is Soraya and I'll be your moderator for the day. Now, for those of you who are new to this webinar, we thank you for tuning in. This is our 4th webinar of the series where we talk about the current market trends, highlights and forecasts on key projects, as well as update on our products and services. We are happy that we've received a lot of positive feedback since we launched this webinar, and we hope that we'll continue to give benefits to all. Now, before we begin, allow me to run through with you the general house rules for this session. Kindly take note that the host will mute your audio and camera during this webinar. This session will be recorded and we will be sharing this recording 7 days after the webinar. Now for the Q&A session, kindly use the Q&A button to type your questions. Please do mention as well to which speaker your question is dedicated to. All right, we will also have a lucky draw towards the end of this session. To stand a chance to win, all you need to do is to ask questions during this webinar, and we will be picking 3 lucky winners to win away a pair of movie vouchers worth 50 ringgit. So stay tuned and stay until the end. All right, now it gives me a great pleasure to introduce to you our 4 esteemed speakers lined up for the day. Now, first up, Dr. Sailesh Kumar Jha, Group Chief Economist and Head of Market Research of RHB. Good afternoon, Dr. Sailesh. Thank you for joining us today.
Good afternoon. Pleasure to be here.
Thank you. All right, up next, we have Mr. Richard Baker, Director of PwC Malaysia. Good afternoon, Mr. Baker.
Good afternoon.
Good to have you with us today. Also joining us today, Datuk Zaini Yusoff, Executive Vice President of SP Setia Berhad and EXCO member of REHDA Malaysia.
Hi everyone. Pleasure to be here.
Thank you, Datuk, for making time with us today. Now we have our very own Mr. Frank Chow, National Research Manager of BCI Central Malaysia. Hello, Frank.
Hi, good afternoon, everyone.
All right. Also in attendance, Ms. Kok Sok Leng, General Manager of BCI Central Malaysia.
Hello, everyone. Good afternoon.
Thank you all once again for making time with us. All right, now before we start, let's do a quick photo session. Right. Now, if everyone is ready, in 3, 1, 2, 3. Are we good? All right, excellent. Now, thank you so much. Stay tuned and we will be back with all the speakers shortly. All right, now to start things off, I would like to invite the General Manager of BCI Central Malaysia, Ms. Kok Sok Leng, to deliver the opening keynote speech. Over to you, Leng.
Thank you, Soraya. Ladies and gentlemen, a very good afternoon. Thank you for being here today, and it's a pleasure having all of you around. One of the biggest news that shook year 2022 is the war between Russia and Ukraine. This news and the geopolitical tensions rising from it has impacted the world, whether directly or indirectly. And adding on top of that is the current prevailing issues that we are facing now. The two prime examples, labor shortages and raw materials price hike. The recovery rate in this endemicity stage is not as what we expected. It is much slower than anticipated, with the issues of labor shortages and price hikes still prolonging. Most sectors are on a neutral ground, or rather a wait-and-see approach, striking only when the time is right. But the question here is, when will be the right time? Well, it is up to us, the stakeholders and players in the industry, to look for solutions to meet the ever-changing market trend. Construction sector is expected to bounce back in 2023 with more optimism in the first half of the year. The government is initiating measures to counter the current deficits in manpower and materials. Our economy will continue its growth amid the challenges and pivot to the new directions. We are one resilient and dynamic nation, with all sectors joining hands to expedite recovery and rebound. There is light at the end of the tunnel. It will take time for us to revert to the status pre-pandemic, but we will get there. A paradigm shift is underway as we move into a different era post-pandemic to meet the new evolution and market behavior, such as working from home, hybrid working mode, stable internet connectivity with work-life integration, and home isolation from the virus. More business opportunities will also surface if you know where to look. To help you with that, we line up these established speakers today. I would like to take this opportunity to thank them. We have Dr. Sailesh Kumar Jha, Group Chief Economist and Head of Market Research of RHB, Mr. Richard Baker, Director of PwC Malaysia, Datuk Zaini Yusoff, Executive Vice President of SP Setia and Vice President of REHDA Malaysia. Last but not least, a cohort of BCI Central, Mr. Frank Chow, our National Research Manager. My sincerest apologies if there are any inconvenience caused by my team in planning of this webinar. Most of all, I would like to thank each and every one of you here for spending time with us this lovely Thursday afternoon. I hope you will all thoroughly enjoy and benefit from the session today. Cheers.
All right, thank you so much for that, Leng. Now, before we introduce our first speaker of the day, let's take a look at a short video from RHB Bank.
Who does progress belong to? It is not just for a select few. It can be enjoyed by those who celebrate priceless moments on their own terms. Progress is for anyone who seeks to defy the odds and pursue their dream. It is not restricted by age, time, or pace. Progress means bringing your business dreams to life, regardless of your background. It is for anyone brave enough to take the step they never thought they could. As the bank that believes in people, we believe progress is for everyone.
All right, now we have with us today, once again, Dr. Sailesh Kumar Jha, Group Chief Economist and Head of Market Research of RHB, who will be presenting to us on emerging market trends in APAC region. Now, for those who have questions for Dr. Sailesh, we will be opening the Q&A session right after his presentation. So do use the Q&A button to type your questions you have for him. Over to you, Dr. Sailesh.
Hello, good afternoon, everybody. Let me get through the most difficult part of my presentation, which is loading my slide. So just bear with me a second. Okay, Frank, am I good to go? Is it looking all right?
Yep, good.
Perfect. So let me just give you the backdrop, heading literally into today, what's going on in the world, and from our perspective, what are the key things to focus on. So, whenever you open your TV, perhaps watch Bloomberg, CNBC, Channel News Asia, any local channels, you open the newspaper, there's a lot of doom and gloom out there, in terms of, as our esteemed colleagues at BCI mentioned, the Ukraine-Russia conflict. In addition to that, a slowdown in the US, potential recession in Europe, risks in China, most recently the issues related to China-Taiwan relationship via the Taiwan Straits, and essentially inflation. Those are kind of some of the big picture themes that are essentially in the back of all our minds and the back of people like myself who are financial market participants. And the key message, and if you don't kind of want to stay for the rest of my presentation or are already bored by what I'm saying, the message that I'd like to give you is that the doom and gloom is unwarranted. We are headed for a slowdown, but we're not headed in terms of global growth and slowdown here in Asia, Japan, and home base Malaysia. But we're not headed for any sort of a collapse or any sort of like a recession, deep recession, prolonged slowdown. It's nothing like that. We're just headed for a typical slowdown, which is normal after we have started exiting this big challenge of exiting COVID-19 pandemic. That's really my key message. So I would look past all the market and media commentators who have been basically professing the doom and gloom narrative. Let me just move over to my second slide. The key things that I'd like to highlight is that we have just released at the end of June, and now a couple of weeks ago, it seems like an eternity, our forecast on growth across the world in terms of our forecast on inflation around the world and in terms of policy rates. And the message really is that, given that Asia, Japan really is influenced by the dynamics of macroeconomic conditions, particularly in the United States, we start from the very big picture, and the very big picture is that the US is slowing. It will slow to around 2.5% average this year, followed by around 2% each in 2023 and potentially in 2024. That for us is just a plain vanilla slowdown of the US economy, slightly below trend, not of essentially a sustained recession or sustained slowdown. It will be, if the slowdown in terms of a balance of risk assessment is deeper than what we think, it will be essentially a quick and fast recovery in our assessment. And what that means is that in Southeast Asia, we will be affected by that slowdown in the US and global growth, but we are headed for just a plain vanilla slowdown, slightly below trend. and not a collapse in economic activity in Southeast Asia, including our home base, Malaysia. On the inflation front, we have a bit to go. Where we think that inflation will remain stubbornly elevated in the second half of the year. It's hard to say when it will peak, but we're thinking that by the year end, early next year, in terms of the month-on-month prints on inflation, not the year-on-year, we should start seeing signs of at least stabilization, if not receding inflationary pressures as far as the headline inflation pressures go. And so what that means is, in terms of monetary policy, a big theme that is out there that is concerning everybody is the dynamics of the monetary policy across the world, starting with the US Federal Reserve Bank, which is the central bank of the US, is that we're closing in to the end of the Fed tightening cycle by year end in terms of the momentum of policy rate increases. Here in Southeast Asia, we are not really in a situation where we're strictly following the Fed. We are just normalizing back to more normal conditions. Interest rates are headed higher, but they're not heading to essentially catastrophic high levels. We're just normalizing back to literally where we came from. And so with these headlines, the idea then is, what do we focus on? The three main themes really are: how much more risk are markets going to focus on in terms of pricing, and that's mainly related to the outlook for growth. The second is, how far does the US Federal Reserve Bank go in terms of the guidance of the future path of monetary policy, and the all-important direction of oil prices, which is partially related to the Ukraine-Russia conflict, but not a whole lot from what we can see in terms of the dynamics of oil prices. So the key conclusion really, as it affects you, is that people participating in the construction sector, is that input prices will remain fairly elevated for the remainder of this year before seeing some sign of recedement at the end, early next year, as commodity prices start showing a more sustainable downtrend. They've already started coming off. Food prices, oil prices have started coming off. In the US, construction prices are starting to come off, but we'll see a more durable decline in commodity prices towards year end, early next year. Interest rates, be prepared that for people who are looking to fund their projects, long-term interest rates are going up. In the case of Malaysia, we're already basically close to around 4% in terms of the 10-year bond yields. A bit more to go, but you'll have to face a little bit higher interest rates, not a whole lot, because we are, in terms of the bond market in Malaysia and elsewhere in the world, closing in terms of the peak 10-year bond yield. In the currency world, many of you, I think, may be concerned, because if you are importing your capital goods or importing inputs for your projects, the idea is that we're closing in terms of the top of the dollar. By this quarter, we're thinking that dollar ringgit stabilizes at the end of this quarter at around 440, and we're in a nice glide path down to 435 at the end of the year. And by next year, at the end of next year, we're potentially down to around 430. So the key conclusion on the currency really is that the worst of the depreciation of ringgit in terms of momentum of depreciation against the dollar and other Asian currencies is probably going to be behind us as we end this third quarter of the year. And over the next 12 months or so, we should see our Asian currencies start appreciating against the dollar. Here are our growth forecasts, just to illustrate the extent of our downgrades. So we have taken into, as much as we can, unforeseen event risks. And one of the unforeseen event risks, not really unforeseen by us, but by many market participants, was obviously Nancy Pelosi's visit to Taiwan. And our basically view is that the problems as it relates to geopolitical tension of the Western allies, as it relates to China and Taiwan, will continue. There's essentially Western allies let's say, objective to ensure that China's domination of the world really doesn't come to fruition. And on the domestic policy front, the Chinese government is intent on ensuring that income inequality doesn't grow at a more rapid pace over the next several years. So we've taken that consideration, this dynamic over the last couple of days in Taiwan in our forecast, and that we have revised to 2.5% growth for the US, and we're at 2% next year, and potentially around that in 2024. Trend growth in the United States is around 2.5%, so slightly below trend. China, we're at 4% this year. Next year, trend growth is around 5% or so in China, so slightly below trend. And in Malaysia, we have downgraded. We've been at the lower end of the government's and Bank Negara's forecast for quite some time, since end of 2021, December 2021. We had started 2022 with a forecast of 5.5%, and we're now down to 5.3%. The Bank Negara forecast is 5.3 to 6.3%. And next year, we're at 4.5%. Trend growth in Malaysia, from our perspective, is around 4.5%. So the downgrades have happened across most countries that we cover, but the downgrades for next year are mainly slightly below trend. So the key message from this slide is we're not headed for some sort of a big recession or sustained recession in the world. On the inflation side, given that growth is fairly solid, going to remain so in many parts of the world, including Southeast Asia, inflation will remain fairly elevated because of the demand side pressures, which are likely to be in place until around the year end. Elevated commodity prices, and unfortunately, supply chain congestions in the US, Malaysia, China, Singapore have started picking up again. So what that means is that this second half of the year, inflation momentum will remain fairly strong in terms of month on month. But by the time we get into early part of next year, and for the whole of 2023, the average inflation rate across the world should drop as economies slow, commodity prices fall, and henceforth what that means is that the supply chain congestions, which are also impacted by strong demand conditions across the world, means that those should start abating in 2023. And hence, you see in our forecast that CPI inflation is going to be at a much slower pace next year compared to this year. In terms of policy rate forecasts, we remain in the camp, the all-important U.S. Central Bank, the U.S. Federal Reserve Bank, that by the end of the year, we are going to be at 3.5%. And basically in 2023, we're at 4%. Here in home-based Malaysia, we think that we're going to be at 2.75% as far as the overnight policy rate goes. And basically the terminal rate, the end rate for Bank Negara, from our perspective, is around 3% to go. So a little bit more to go, but not, I would say, by the year end, we should be in a situation where that momentum of policy rate increases, with the exception of Western Europe, which is way behind the US and Asia, should start showing signs of a little bit slower momentum of policy interest rate hikes as we head into 2023. Let me just show you briefly some charts to give you an idea where we are in the global business cycle. So if you look at the red line, this is the momentum of global industrial production, month on month, 3-month moving average, just to smooth the data. And you will notice that from around March, April of 2020, all the way to February 2022, we had a very strong pickup in growth. And lots of volatility in this global industrial production number, simply because across the world, we had on again, off again in terms of lockdown, on again, off again in terms of reopening, on again, off again in terms of international travel, etc. And hence, that's why we've had a fairly bumpy ride, a very volatile trend of a global industrial production. But keeping in mind, we had a massive pickup in growth from March, April 2020 to around February 2022. It's only normal that we slow, because a lot of the reopening has happened. People have spent some good amount of money in the first half of the year. All the tailwinds from loose fiscal monetary policy are starting to basically end in terms of impact on consumer and business spending. So we're just headed for a plain vanilla slowdown is how I would characterize the slowdown that we are observing in our view. Now, what that slowdown does is there's pros and cons to any slowdown. So if you look at the right-hand side chart, global industrial production and Brent oil prices, or oil prices in general, move in the same direction. So as global growth slows, which it already is, you notice that Brent oil prices are coming down. To put things in perspective, way back in the day, in March of 2022, we had a lot of international banks calling for Brent oil prices or oil prices in general going to $120 per barrel, $130 per barrel, $150 per barrel. And our key thesis is, from a geopolitical perspective, it's not going to happen. More likely that Brent oil price will peak at around $100 to $130 per barrel, mainly due to our geopolitical angle in terms of forecasting oil prices, that the Indians and Chinese entities would continue to buy Russian oil, and essentially Russia would continue to export oil throughout the world, as well as other commodities. And that's exactly what's happened. This is an objective view. It's got nothing to do with any of my political views, which I don't have any, being a sell-side analyst, but it is just the nature of how the world works. And that's what you all need to consider from a geopolitical perspective. If there's some geopolitical angle affecting some prices that you are exposed to, it's important to be very objective of that. And that generally works much better than listening to the media or essentially sell-side analysts such as myself. The tightening of monetary policy across the world has impacted global growth. That we cannot escape from. As interest rates rise, global money supply declines, and global growth does come down, and also affects sentiment in financial markets. And that's why stock markets have gone down considerably. If you look at the left-hand side chart, and basically, returns on bonds have also gone down a lot. But as we're close to the end of the tightening cycle in many parts of the world, you're starting to see global stock markets recovering and bonds starting to recover as well. Let me skip to a few more slides and then think about, I've given you the big picture as it relates to the developed world. How does it affect us here in Asia? It affects us profoundly. If you notice here on slide number 13, left-hand side, right-hand side chart, the red line is Asia exports and the blue line is US consumer spending as represented by US retail sales. As US consumer weakens, which it already is, then our external side of our economies in many parts of Asia actually slow. Why it's important is because those export-oriented sectors do generate weaknesses in terms of employment related, both backward and forward linked, and then hence feed through to businesses in terms of slowing pace of business investment, and then slow down in consumer spending. That's how the mechanism broadly works as we see a US slowdown staring us in the face, if you'd like. In China, we're not really bearish, but we are essentially of the camp that China is on a structural decline, in terms of growth. So some of the recent indicators that we track from our proprietary database as of early first week of July, China is essentially just below trend. In terms of, that's the left-hand side in the manufacturing sector, and port containers in China, the activity is really, really low due to COVID-19 restrictions. The summary point on China really is that there's a lot of hope and smoke in the business and financial market community that you have to be involved in China. You cannot not be involved in China. You take your pick, you run your own business. That's not for me to comment. But the bottom line is that China is on a structural decline over the next couple of years. And what the main support for the world and for Asia is going to be coming primarily from the US, from our perspective. There have been a lot of talks about stagflation. Slide number 16, stagflation is mainly a Western phenomena. And I'll just spend 2 seconds on this. Over the last, 100 years or so, stagflation has mainly been a U.S. phenomena, and even in the U.S., since 1914, for which we have the data from, it's only been in the 1940s and 1965 to 82, which we observe of stagflation in the U.S. So the key conclusion from this slide is not that easy to generate stagflation anywhere in the world, and we don't think stagflation is this year's phenomena or even next year's phenomena. That's really not in our forecast, and that's not what we think is going to be the state of the world over the next 1 to 2 years. Inflation, as you can see in the US context, still fairly elevated, whether it's in the headline case or in the core PCE. Importantly, what's worried us is that the supply chain congestions in the US are starting to accelerate. On the left-hand side chart, all you need to know is that the orange line is the threshold for congestion. Any number above 2.8 in the orange line, what it's indicating means that congestion is high, and congestion is re-accelerating in the US. Not as bad as what you saw in the peaks of a number of 3.1 in the second half of last year and early this year. And in terms of the port containers, low activity, meaning that not enough trucks to ship the stuff inland, still fairly elevated. So this is the data is as of mid-July, doesn't look good. And similarly in Singapore, where I am currently on leave, for your information, at the Keppel container terminal, we're seeing activity decline. This is as of early July, not looking good. And then in Shanghai Logistics Center tracker we have as of end of May, it's not looking good either. Home-based Malaysia, like the US, we track it in terms of congestions as of mid-July, starting to basically bounce around above the threshold of 195 million, and low activity at the ports is also picking up in terms of not enough trucks to supply to take the goods inland from our ports in Malaysia. So the key conclusion is we have to bear with the supply chain congestions and pretty resilient growth in the world for a bit more towards year end, early next year, before we see a slowdown in inflation coming. So let me basically talk about, to a certain extent, the areas that you are interested. One of the themes that we like to think about is what's the market pricing in? Is market going to price in some sort of a financial crisis in 2023, like a global financial crisis or an Asian financial crisis? And the idea is probably not. Some markets are very worried about the world, like the dollar, which is very strong, in terms of stock markets until first week of June or so had been selling like there was no tomorrow. But the bottom line is we rule out this possibility. And some of the key indicators that we look at, like debt service ratios, real effective exchange rate, stock markets, credit growth relative to trend. These are some of the indicators that we look at from empirical evidence from 1870 to 2010. We're not seeing any signs of worry. But residential property prices in some major markets such as US, Europe, China, and Japan are fairly elevated. These are just some summary charts, still well below trend. So we're likely to see in some of the major economies, and potentially here in Southeast Asia and places like here in Singapore, where I am currently, crazy property prices here in District 9, where I'm located, 30 to 50% increase in rents here in Singapore due to the large influx of Chinese money over here. Bottom line is that we will most probably, in terms of residential property prices in many parts of the world, major economies in particular, some parts of Asia, China is starting to correct, see a softening and receding of these prices in real terms. That's the bad news. The good news is it's not a collapse. We're not headed into some global financial crisis, Asian financial crisis, a slowdown in the residential property sector in many parts of the world. The second macro theme that one has to be cognizant of is the Fed. So I'm just going to be very brief here and say that we're headed into the tail end of the Fed hiking cycle, where we're likely to be, around 3.5% at the year end and 4%. Markets priced for that. We have 75 basis points to go in terms of September, November in our forecast in terms of hikes. And by the year end, we should start seeing the Fed indicate that we are close to the end of the Fed hiking cycle. What that does for us in exchange rates is good, because two things have been impacting weaknesses in currency. So, for example, in home-based Malaysia, the big pickup in dollar ringgit from 420 at the end of first quarter to 440 at the end of this second quarter, and now we're at around 445 and change, has been essentially flight to safety to the dollar, as worries on global growth and U.S. growth have been in the minds of currency market traders, and also the interest rate differential, which has gone against ringgit versus the dollar. As we progress towards year end, as the Fed ends its hiking cycle, and it becomes clear that we're in a plain vanilla slowdown, we are unlikely to see the flight to safety that we have been seeing for some parts of this year. And you can see in our currency forecast that across the board, most likely, we are likely to see a bounce in Asian currencies, stronger levels by year end against the dollar, and for the better part of 2023. So the key conclusion is that if you have dollars, good time to basically sell and buy Asian currencies. If you're looking to buy dollars versus Asian currencies, then wait a little bit. Patience would be your virtue. If I may go straight now to commodity prices, important for all of you. The bottom line is that commodity prices are headed south. So for oil, we think that essentially next year will average around $75 to $80 per barrel. And this year we're around $100 or so. At Brent, we're already trading below $100. That's been our call. And with that, if you look at this chart, food prices, metals prices, all to some extent move together. And so if oil prices are coming down, it means that metals, food, and some of your input costs that go into building construction should start showing a much more profound slowdown in price pressures by year end, early next year, and a nice glide path down towards the year end. I go straight now into the Malaysia economic and policy outlook. So as I mentioned, so far so good. Looking pretty nice in terms of the momentum of growth. So far in the year, we're at 5.3%, above trend this year, not bad. And next year we're at 4.5%, a little bit below trend. In terms of policy interest rates, like I said, we are just normalizing, meaning Bank Negara is just normalizing the overnight policy rate to 3%. That's kind of where we came from, and essentially dollar ringgit in terms of movement up and movement up of bond yields. In terms of long-term bond yields in Malaysia, we're closing in to the end of that cycle. The good news is we have second quarter GDP out in mid-August. That should show a pretty strong number. But we are headed for a slowdown towards the year end. We are already starting to see manufacturing sector slowdown from our own proprietary indicators dated mid-July. This is all proprietary data, and that is related also to the publicly released IHS PMI. So we are already starting to see signs of slowdown in manufacturing from our own data, not the official data. And in terms of the reopening of the airports over here in domestic and international travel, our RHB Malaysia Airports passenger parking index, which is just a kind of as best as we can do in real time to see how the activity at our airports is and international domestic travel. We're clearly not back to pre-COVID. Unlikely that we're going to get there this year or next year. We're already starting to see signs of slowdown in terms of the airport travel. So more likely than that, the slowdown in tourism will become more pronounced by year end. The consumer remains strong. We have, again, from our proprietary database as of 12th July, looking pretty good. And that's basically because unemployment, labor market conditions, unemployment rate is coming down quite nicely. Unemployment rate and consumer spending are inversely related on the right-hand side slide. As employment rate drops, consumer spending improves. That's the good news, but the bad news is on slide 46 that US consumer and Malaysia consumer are intricately related. Because slowdown in US consumer spending on the right-hand side leads to slower export in our country and decline then in employment growth and labor market conditions, which have been fairly decent, fairly widespread improvement, should start seeing signs of early deterioration at the end of this year, headed into next year in some parts of Asia, like in places like India, to some extent in China. That slowdown in labor market activities in financial sector, essentially in tech sector, business services, is already evident. So prepare for essentially the labor market condition to deteriorate a bit towards year end, a little bit more. Nothing catastrophic, but the pace of improvement that we have seen so far, first half of this year and late last year, that's probably going to be behind us fairly soon. In your area, in terms of construction sector, again, we have real-time data as of mid-July. Construction sector activity index well below trend, continuing to decelerate. The three main drivers why this is happening and is likely to continue to progress along these lines of slower pace of activity over the next 6 to 12 months. Outlook doesn't look good. As Surya mentioned, labor shortages. It's not clear to us that those labor shortages are going to be solved so quickly. Point number one. Point number two is that input costs have been going up quite a bit. Some of the projects have been that we monitor have been impacted by strong inflationary pressures. And the third is that the government's development expenditure programmed at around 72 billion this year, development expenditure program, unlikely to materialize. Maybe in the low 40s, kind of what has been the trend over the last couple of years is what's going to happen. So the outlook for construction in itself as a whole doesn't look that promising over the next 1 to 2 years. However, there are pockets of strength. The areas where we think there are pockets of strength based on our conversations with clients and corporates is essentially logistics sector in terms of warehouse activity, and that's on back of but quite a bit of foreign direct investment coming forward from many parts of the world, movement of activities from China to essentially Southeast Asia and Malaysia. That's where the pockets of strength are. Residential property sector doesn't really look that exciting for us, given the overall macro backdrop. Again, there are always pockets to invest in, even in residential, but it's not something that we would say is the place to be. More commercial, more logistics, more warehousing type of areas within construction property where we would be relatively more positively inclined. Inflationary pressures are up. I don't think that's a mystery. We've revised up. We are now in the camp of 3.2% to 2.85%. The inflationary pressures are picking up, will continue to pick up over the next couple of months. By September, headline inflation, we're likely to be around 4.5% to 5%. That is a conservative estimate. And that's the reason why you will probably see 1 to 2 more hikes by the central bank in terms of raising the overnight policy rate before settling at 3%. We're currently at 2.25%. So we've got 75 basis point more of increases in policy interest rates. So I'm going to just stop here because I've taken up a lot of time and give you just my key conclusions. Don't get disheartened by the doom and gloom that is being propagated in the media and among certain financial institutions of the world. We're headed for a slowdown. It's a plain vanilla slowdown. And the idea is plain vanilla slowdowns eventually lead to recovery. And the balance of risk is that sometime in second half of next year, we have some ways to go, unfortunately, a solid year or so. before seeing signs of recovery. So there is some light at the end of the tunnel, and you just have to be prepared to be fairly conservative when you think about expanding in terms of adding, engaging in expanding your factories, engaging in big projects. And in terms of the currency, the ringgit is probably likely to start showing signs of strengthening against the dollar by year end into 2023. And the peak of long-term interest rates in Malaysia were probably there in this third quarter of the year. So I'd be happy to take any questions.
Excellent. Thank you so much, Dr. Sailesh. We do have two questions for you, in fact. And the first one is actually from our research team. Do you think Malaysia is considered a low-risk country for investments, considering the current geopolitical issues globally? Dr. Sailesh?
I mean, it's hard. I would say here's what's what's positive for Malaysia first. Okay, the first is that the dislocations in China and North Asia are fairly positive for Southeast Asia, including Malaysia. From that geopolitical angle, if you'd like, that specific geopolitical angle, one of many, if I may, and that's because what we are observing is that the foreign direct investment and in terms of companies upgrading their factories and equipment, that's already happening since the end of last year, and it's been pretty good. That has provided some offset to the weaknesses we have seen in construction sector. Otherwise, investment spending, what we call in technical terms gross fixed capital formation, would have been much weaker. The geopolitical impact of, let's say, the Russia-Ukraine conflict has impacted us via supply chain congestion, not entirely anything to do with Malaysia per se, because from a policy perspective, the government has been fairly active to ensure that we don't get a blow-up sort of situation like in the US and China. That's looking good. And thirdly, the slowdown that I'm talking about is mainly an external event risk. That's the idea. It's nothing like something that is homegrown. That's the good news. The bad news is, or not so good news, if you'd like, I don't want to be too negative on a beautiful afternoon in KL, but not so good, beautiful afternoon here in Singapore, is that it's raining here actually, is that the elections. Right? I hardly comment on politics in Malaysia, but how I put forth my view is that uncertainty in terms of the general elections, and that has more to do, it's not, I can't comment on the composition who we think will arise from this event risk, but what I would be guiding, what I guide investors is what matters for us, all of us really, is in terms of policy. And the policy is about more to do with fiscal policy. Is the GST tax reform going to happen sooner rather than later? We think that the GST tax reform could potentially be announced in March for implementation, end of 2023, early 2024, if not GST, other type of tax reform. We also think that some of these one-off, prosperity tax will not be renewed, right? Because that's just something that the commodity sector is not amenable to, and essentially things like contribution from our oil companies like Petronas, they will have to contribute more, and the transfers to state governments like Sarawak potentially could be less to make sure that the fiscal deficit issue doesn't create sentiment-related issues as far as investor sentiment. From what I can see from international financial markets, right, that's my main expertise, obviously, not being Malaysian, is that the sentiment is neutral. Right, and that's pretty good given all the challenges we face here, because one has to recognize that in terms of the structural reforms, we're a bit behind our neighbors. I mean, that's just a illustration of numbers. It's not a personal view. It's in terms of what we have been seeing in terms of growth, policy changes. We're a little bit behind Thailand and Indonesia. But nevertheless, it's not like we have been seeing now more recently a lot of selling pressure in our currency, a lot of selling pressure in bonds and equities. The financial market sentiment would give you that, but we're not seeing that. So the key conclusion, Surya, in a long-winded manner, is I would say is a neutral. That's how I would characterize it.
Neutral.
Yeah?
Okay, that's good to hear then. All right, Doctor, we have another question for you. And this one comes from one of our audience, Kin Man Fong. And he says, according to S&P Global on the 20th of June, it acknowledges that in 2022, scarring will be the largest felt in Philippines, India, Malaysia, and Thailand. Hence forecasted for APAC GDP growth of about 4.8% in 2023-2025. So is this perspective still obvious or vogue based on the current volatile market? Doctor?
So I can't comment on other people's forecast, right? Because I wouldn't know where it came from. But what the key message from slide number 4 is we're just headed for a slowdown here in Malaysia to 4.5%. And even in 2024, we have 4.5%. Trend growth is 5%. We have acknowledged as much as we can, all the challenges ahead. So when we forecast, so RHB is a little bit peculiar, I may say, since I joined the firm, by my own design, because I run the team, so I'm maybe a peculiar guy, but we don't change forecasts very often. So in the marketplace, you will see a lot of people upgrading, downgrading. We don't do that. So our first forecast change on Malaysia GDP after December, first week of December 2021, was in June 30, 2022. Hopefully we don't need to change again. So we allow ourselves around 2, and that's considering most of the risk that, including this Straits of Taiwan risk that all of a sudden, because thanks to our friends in America, Nancy Pelosi visiting, not a political comment, but it was kind of in the back of our minds. It's in our forecast. Yep.
All right. Okay. Once again, thank you so much, Dr. Sailesh. I'm afraid we are running out of time. We would love to have you back again. Maybe, you can explain more about this. It's been very, very insightful indeed. Once again, thank you so much for spending your time with us, sir. Thank you. All right. Now, before we proceed to the next speaker, we will be playing a video brought to you by Construction Plus magazine. We are happy to inform that all attendees today will be given a complimentary 1-month membership to access the digital magazine for Construction Plus. You will receive an email with your login information from us by next week. Construction Plus is currently running a giveaway campaign on Instagram. To stand a chance to win a lifestyle gift card, follow the steps shown on screen right now, and do check out the Construction Plus Instagram for more information. All right, now it's time for us to welcome our next speaker of the day. But before we introduce him, let's view a short video from PwC Malaysia. We're happy to have with us Mr. Richard Baker, Director of PwC Malaysia, sharing with us on how can Malaysians stepping up and incorporating ESG in their business practice. Over to you, Mr. Baker.
Good afternoon, and thanks everyone for taking time out of your busy day to attend this seminar. I'll just share my screen now. Okay, so today's topic, just wanted to share everyone the ESG, and in particular in the construction industry, and how this is going to impact our practices and our lives, particularly in this industry. So I myself am a chartered surveyor by background. My main area is in construction. But I did notice that ESG is becoming a very hot topic at the moment. You can see from the news articles, from the video just shown there, the temperatures are rising across the globe. There is flooding, there is famine in areas, there's wildfires going on at the moment. So this climate change and ESG perspective is becoming a very hot topic at the moment, okay? So particularly in the construction industry, there's obviously three elements to it. There's environmental, there's social, and there's governance. So social is mostly about gender diversity, living wage, health and safety of the workers. You have governance, which is talking about tax frameworks and pay and the structuring of the business. But my main focus area for today would be on the environmental side, the E. And this is where I feel that the construction industry plays a very big part, and there's a lot of changes that need to be made in this industry for this environmental side. So we can see from news articles, I took some snippings there from websites and articles. We see a lot of companies now taking this ESG agenda very seriously. So you've got examples here of Nestle, PwC ourselves, McDonald's, IKEA. They are now showing and proving to people that they are now wanting to be green, sustainable, and showing change, okay? Now, this is very important because not only they want to show impact to their customers, you know, they want to show that they are being green and being ethical, but also there is now pressure from above, from finances as well. So a lot of the large banks, a lot of the private equity funds now are only investing in ESG credentialized businesses who have good roadmaps to lowering carbon emissions, showing their ESG agenda. So we see a lot of businesses now and companies adopting this ESG agenda and actually thinking about their whole business practices from start to finish, of having this in mind, this ethical and sustainability in mind. Okay, so the main one from a construction perspective, as I mentioned, would be the E side, the environmental, and a key part of that is your greenhouse gas emissions and your embodied carbon. Okay, so where we see a lot of people now in Malaysia, particularly adopting this, is actually in their building construction and their methods of construction. So you can see examples there in news articles. McDonald's obviously open a lot of stores per year. They're investing quite heavily into energy efficient equipment and renewable energy photovoltaics for all of their restaurants. So they want to be seen and showing to be caring for the environment, to be adopting to the change and to show their customers that they do care. Similar again, Starbucks also opening similar green stores. Also, you know, you see the adoption of their withdrawing of the plastic straws. So they are completely committed to this ESG agenda and environmental practices. And even to the extent where we have Caltex petrol stations, right? So we go into the very more niche areas, you know, where you would think, why would how could a green petrol station, how can that come about? But they're actually now adopting green practices in even a petrol station with LED energy saving lighting, energy saving air conditioning in the kiosks. So this is something that is happening throughout the construction industry, talking about small retail outlets to large malls, hotels, and offices. And it's not something that's going to go away, because it's going to get even more and more obvious, more and more prominent in the construction industry. So the issue is always in construction. We have the cost versus benefit, right? There's a thought process and general practice that people think is that green is more expensive. Green equals a higher cost, okay? So that is always the case in any industry, that when something new comes up, the cost will be very high. You think back to when first, large screen TVs came in, and 4K and HD TVs, the cost was always very high. But as things slowly begin to be adopted and become part of the mainstream, the cost will reduce. And you can see that now with photovoltaic panels. The cost at the start, back in 1970s, when they were doing it in space shuttle and space stations, was very, very expensive. To the extent now where homes outside have got solar panels on their roof, they are now quite a good source of sustainable credentials, and also that the return on investment is quite low now as well, because the cost of installing, the cost of the asset is slowly reducing. So what other benefits are there? Why should we adopt this ESG agenda? Why should we focus on the environmental in the construction industry? Well, number one is obviously the feel-good factor, right? We want to show, as a company, as individuals, that we are caring for the environment, we're caring for the social side, we're caring for the adoption of environmental credentials, okay? So from a personal perspective, but also from a company perspective as well, we want to show our customers that we care. And also actually now we're seeing a lot of demand from tenants, so if I'm a tenant of an office building, I'll be particularly looking to go and rent a space in a green credentialized building to show my investors or my board or the general public that this is something I'm keen on, and also something I want to adopt. Okay. And also from the opposite side of it, we are seeing now landlords saying that I will not rent a space out to you until you show me your ESG credentials, your ESG agenda, your roadmap. So they're now being very selective on even what tenants they want to take in, which is a very powerful message if you think about it, because the landlord is willing to give up rental. He's willing to forsake his income to show that he only wants sustainable and green credentialized tenants in his building. Okay. On the opposite side of that, we've then got defining the balance. Like I mentioned to you before, the cost of implementing something new is always very high. So do you want to be an early adopter? Or do you want to be the guinea pig where something has maybe not been tested thoroughly? There's still some tweaking needs to be done. The cost is a little bit higher. We need the trailblazers in the industry to take on board these new technology, new ways of working, new construction methods to show they do work and to help it become mainstream and be adopted into the construction industry as a whole. Obviously, with CapEx, costs generally will be higher for a green building and a green materials, but also the OPEX cost, the operating expenditure. Because you're installing green assets and green items, energy saving items, the overall operating expenditure will reduce. So if I'm a landlord of a mall or I'm a building owner, I will benefit from installing these green assets by having reduced operating expenditure. My energy usage will be reduced. I can actually generate my own electricity through solar panels, so I'll get back the benefit from there. And also the cost, as I mentioned before, what is the ROI? On a like-for-like comparison, generally green items are a little bit more expensive. We're not trying to avoid that. But if we can slowly adopt them, the ROI will slowly reduce to the point where it's no longer seen as a green credential, green asset. It's just a normal thing that happens in every building. That's where we want to work towards. Okay. So because of this problem with cost and with increased expenditure for green assets, there's sometimes a carrot versus stick approach. Okay. Do we try to force people to adopt ESG, the stick approach, by giving penalties and trying to force them to do it? Or do we give the carrot approach where we encourage, we incentivize to try and help them to adopt it? Okay, so there are certain incentives available at the moment, which Malaysia is adopting to try to do the carrot approach. They're trying to give incentives to the manufacturers of these green materials and green construction assets, and also to the building owners themselves to try to encourage the adoption of these green and sustainable options. So the first one is for manufacturers. If you are a manufacturer or a supplier of green products, there is what's called a My Hijau website. where you can go in and register and get a My Hijau mark for your asset or your piece of equipment to show that the thing that you are manufacturing is green, is sustainable, and has credentials there. So they certify that. Now, this My Hijau website is a website anybody can go on. Yourself can go and search there, and it will list all the products and manufacturers on there who've got this registration. So this is a very good platform to promote your products. If you go and buy my product, it's verified green, you will save costs on your OPEX versus another competitor who's not got that My Hijau mark. Okay. The other good thing for manufacturers on registering on this website is it's used as a government green procurement. So as part of their mandate, the government are required to try to procure green assets in preference to a normal asset. So if you're registered on this website, obviously the opportunity to potentially be procured by a green government body or government department is a lot higher. And as I mentioned before, it's a unique selling point. So it's something you can use to market your products, market your equipment to show, hey, I'm actually better than my competitors because you'll be able to save energy costs. It's been verified, it's been certified, and what I'm saying is true, and the energy savings are correct and accurate. Okay. And also, depending on your industry, depending on what product you're manufacturing, there's also some potential incentives for the manufacturer themselves. So under MIDA, the promoted activities and products, some products are able to get some incentives if you're a manufacturer of it. So for example, if you're doing energy efficient lighting, that is one of the products that they look to promote, and they will be willing to discuss incentives with you from your own company's perspective. So that is from the manufacturer side. There is then the option for building owners and building tenants. Okay, so to try to incentivize them to adopt these green equipment and energy saving equipment, the government is also giving the owners and tenants a tax incentive. Okay, so this is called GITA, G-I-T-A, and this is available for qualifying expenditure on green projects or green assets. This is up until 31st December 2023 at the moment. No news on an extension yet, but previously it was extended. So can't say promise you, but likelihood that obviously they want to continue the adoption, it may well get extended. And there's also a income tax exemption, GITE, for green services companies. So if you're a green consultant who is advising clients on procuring green or doing sustainability studies on green buildings, then there's also an incentive for you as a company as well. So in terms of how this incentive works for building owners, it's a tax allowance used against your statutory income, which for all those non-accountant or finance people basically means it just reduces your tax payable. And the claim is available for 100% of the capital expenditure. So if you spend 100 ringgit on a qualifying asset, you'll get 100 ringgit of tax deductions available over a period of time. And because in Malaysia, the corporate tax rate is 24%, essentially you are saying for every 100 ringgit you spend, you save 24 ringgit of cash, because it's a reduction from the tax of your company. Okay. So in terms of the options, as I mentioned before, there are assets and there are projects. Assets is available on 50 types of approved green assets for energy, building, and waste. These are more designed towards the generation of electricity. So a lot of incentives, assets available there for biomass, wave power, hydro, those kind of things. But there are certain ones available for building as well, like energy efficient lighting, some of the chillers in your aircon system. So it's slightly reduced, I would say. There's not a wide approach for buildings themselves, but there are certain ones available to you. The one that is more interesting for building owners is the project side of it, the one at the bottom there. So this is available for qualifying projects if you're involved in renewable energy, energy efficiency, green buildings, green data centers, or waste management. And I'll go into explain those a little bit further on the next few slides. So to give you some examples of assets, as I mentioned, quite a lot of it is for generation electricity, For things that may be relevant to the people on the call who are in the construction industry and building owners, you have assets for chillers, energy efficient chillers, cooling towers, which will be part of your aircon system. If you have a cogen generating your electricity, if you have building energy management systems, if you install efficient servers for IT, or if you install LED energy saving lighting as well. So these are an incentive for the asset. The cost that you incur for buying these assets, as long as they're registered on the MyHijau website, you can claim the incentive back for your CapEx costs you incur on these. So on the MyHijau website, you can go and search for your model and manufacturer name of what you bought. There'll be a certificate on there. You download that, you include your invoice for what you bought it for, make sure the two match, submit your application, and you'll be able to claim the incentive from your company. Here's an example of the MyHijau website. So it's quite user-friendly. You can either type in your model name, you can type in a general category, or you can search, and then you can look up your different types of equipment here. Example here is York, which is for a chiller. If you click on that, and that's the model that you've bought, you'll then be able to download a certificate and claim the incentive. So moving on to projects where it's a little bit more relevant. These are for a wider scope of the incentive. So for asset, we're just talking about individual assets by themselves. For project, that scope is widened a little bit larger. Okay. So the first one here is for renewable energy. So if you're involved in the generation of electricity, or steam, or heat, or chilled water, using renewables such as biomass, biogas, hydro, geothermal, or solar panel, all of those costs, all that CapEx you incur to that renewable energy project can be considered for the incentive. So things like the solar power, for example, you have the cost of the panels themselves, you have the cost of the converters, the cost of the electrical equipment and the wiring, the cost of the frame system itself on the roof. Because we're talking about project now, we can include all those costs in together as part of the claim. So it can be a lot wider, a lot more beneficial claim to go in the project. Okay. For energy efficiency, we're looking at where you install equipment which are energy efficient compared to a normal standard. So if you buy a particular type of air conditioning system and you demonstrate there is certain energy savings over a year compared to a normal industry standard, you can then go and apply for this incentive and be able to claim that. So anything that's energy efficient, not just individual assets, but the system itself. Another thing we are seeing a very big uptake in is green buildings. So a lot of building owners are actually going to look into getting their building green rated. So in Malaysia, we have GBI, Green Building Index, or Green RE is another one. If you go and get your building certified by that locally developed rating tool, then you'll be able to claim the cost uplift of making that building green. So let's say, for example, I want to build an office for 100 million. If I make it green, GBI rating platinum, for example, it'll cost me 120 million. I can claim the 20 million uplift for those costs, depending on certain criteria. So something we see a lot of people adopting now is this green building certificate. And this is another option for you if you are looking into that. And then lastly, waste management. So if you're recycling, waste treatment, composting, anything to do with waste management, all the costs for that type of project as well, the CapEx you incur for that can also be applied for this project incentive as well. Okay. So in terms of the project one, because the scope of the incentive is a lot wider, as I mentioned, a lot more costs can be included together. The steps involved are a little bit more specific. So in the example of the asset one, you just go to the website, you download a certificate, you submit your invoice. It's pretty straightforward. For a project one, you need to show in your application the savings and the benefits that are going to be made through your project. So what happens here is you have to make an application at the planning stage before your receipt of your first invoice, before you receive an invoice for that green project you want to claim for. You have to submit an application, quite high level with some information like the company background, employees, and what kind of capex you're going to incur, what kind of systems you're going to install, and an estimate of what the energy savings would be. This application goes to MIDA, and they will then give you an acknowledgement letter to say, yes, I've received your application. It's all good. Please go ahead and start the construction process. So now you can start to receive invoices. You then go ahead and construct your building, do your internal renovation if you're a tenant, and then you finish that construction or renovation work, and then there will be a verification. So any of the savings, energy savings you calculate at the start, your initial application, will then be checked actually against what you are physically saving once the building or renovation has been completed. So if you submitted saving, you're going to save 10 kilowatts of energy, you have to make sure that you are saving that actually when the building is in operation or when the renovation has been completed. So there's an annual verification process to be done. Once that has been verified, another letter will be submitted saying, yes, you've passed all the criteria, you can then go ahead and claim the incentive. So it's a little bit more of a planning step. You have to make sure that you apply the correct timings, make sure there is calculations and engineers involved to check. But as I mentioned to you before, the scope of the incentive is a lot wider, and that is why there's a little bit more steps, a little bit more specific in terms of the application process. Okay. So as I mentioned before, the project side is a lot wider claim. So if we are going to claim energy efficiency as an example for an air conditioning system in an office building, we don't just claim for the chiller like on the assets list. We can actually claim for the aircon units themselves, the chiller, the air handling unit on the roof, the cooling tower, all the ducting and piping, all the pumps and ancillary equipment. So it's a whole system-wide cost. So you can imagine that scope of the incentive can be a lot wider. And that is why we see a lot of clients and people applying for the project side of it, because there's a lot more potential incentive available. The list of criteria there is quite strict. You know, they will follow and make sure that you are ticking the box for every single part of that. But this is something that we see, and we can hopefully see a lot of people adopting this. As I mentioned at the very start, this ESG agenda is not going to go away, and greenhouse gas emissions and embodied carbon is a very, very big part of the construction industry. So as you can imagine, if everyone was to be, every building owner or every tenant was to install this energy saving equipment, it would have a very, very big reduction in our greenhouse gas emissions, and also what we are taking up as well in terms of energy and electricity as well. So these are some of the examples of incentives I just want to share with you. That's all for my talk. If there's any questions, I'll be happy to answer them. Thank you.
All right, thank you so much, Mr. Baker. Thank you for sharing. It was very enlightening indeed. We will come back to you for the collective Q&A session. So a gentle reminder to our audience, for those who do have questions to our speakers, kindly use the Q&A button to type out your questions. Once again, please mention to which speaker your question is dedicated to. We will come back to this after our last speaker. And now, up next, we will have with us Mr. Frank Chow, National Research Manager of BCI Central Malaysia. And today he will enlighten us with the data on opportunity search in building segment. Over to you, Frank.
Hi, good afternoon. Hi, welcome to the Malaysia Construction Market Update, this mid-year series. My name is Frank. Thank you for spending time. Right, before we jump into our statistic, how do you feel about the construction industry pace on the outlook, right? Is good, positive, or is not so? I'm feeling positive because this is a lot of investors over the globe have actually shifted their attentions to countries in Asian regions such as Malaysia. where the economic growth has not plunged as in other parts of the world. Inflation rate also is less intensive, right? Because of the monetary tightening across global central banks, slowdown in China. So the investor wave is now different. It's a shift, right? So looking into 2022 this year, so the biggest issue in this year will be how resilient, right, in the construction industry in managing supply chain risks and shortage in labor. So nevertheless, the same challenge has pushed Malaysia construction industry to leverage various less labor-intensive methods, such as prefabrication, modular construction, and emerging technology like BIM to monitor risk in supply chain. So this is an overview graph of Malaysia construction commenced value in million USD from the period before the COVID pandemic in year 2019 until current year. The red bars are construction commenced value, while yellow bar is the forecast value for construction commenced in second semester this year. We take construction commenced value as one of the key figures indicating how performance in each year or across a period of multi-years. So in year 2020, the data shows 12.5 billion USD. It's a 26% drop in the construction value as compared to previous year in 2019. Total movement restriction and the extension of MCO has caused minimal construction activity at that time. But moving into 2021, we see a shift taken place. Despite MCO in major states like Selangor and KL, construction seems to gain more traction toward the second semester of 2021. And some contributing factors include government start to pump in smaller infrastructure projects to support the industry. And we also saw loan moratorium for affected individuals and SME company that helps also to uplift the construction landscape at that time. So looking into current year, we start with a positive scorecard in first semester 2022. Around 10 billion USD worth of construction project has come to realization. And our data forecast another 17 billion USD worth of project to kickstart in the second semester this year. That make up 40% growth rate in year-on-year comparison. This is compared to 2021. Though the construction industry is still facing challenge, I would say, with rising raw material price, but the demand in construction property market continue to fuel when reopening of the border gradually happened from last April onwards. And construction players regain more confidence this year as we move into the new normal. Next, we'll focus on building segment in the industry. The chart shows building construction commenced value in million USD from the period 2019 until 2022. And the yellow bar is the forecast for the constructions commenced in second semester 2022. And the red bar, construction commenced value from 2019 until first semester 2022. Chart shows similar patterns with more or less the same growth with the previous chart in year-on-year. Construction commenced value in the first semester 2022 is 6.7 billion USD. And it's expected to expand another 14 billion USD in second semester 2022. The year-on-year growth is 31% compared with 2021. Some measurement has been in place that positively impact the building segment that will include government have added more building materials into the variation of prices, VOP clause, to help contractor who does government projects. And Indonesia has also lifted ban for their workers to return to Malaysia. This will help to ease worker shortage in the building construction segment. Yep. Building construction commenced this year according to the category distributions. So value is included realization and also the forecast value respectively in both the period first and second quarter this year. Residential is the primary driver in the industry that contribute 55% of the total construction value, and construction value amount to 14.8 billion USD, followed by industrial value at 3.4 billion, 13% of the total value, and office 2.2 billion USD, which is 8% from the total value. And surprisingly, hospitality project are ranked number 4 contributor in the chart. It's around 1.8 billion USD, 7% from the total value. Overall, strong comeback we see for residential sector in the building segment this year in terms of both construction realization and the forecast value, as compared to the previous year where construction industry is driven mainly by industrial project in 2021. Next graph, we'll be looking at building construction commenced value in million USD according to the region. And that is consists of constructions commenced value in the first semester in red bars, also the forecasted value in the second semester. Central region has recorded the highest value in construction command in both semester. Right? There are continuous supply to actually address rising commercial property demands in populated townships within Klang Valley. And development in northern region, namely Perak and Penang, have surpassed the southern region like Negeri Sembilan and Johor in recent years. This is due to strong growth in industrial manufacturing sector that create job opportunity at the same time the housing needs, especially location like Tapa, Seberang Perai, and Bayang Lepas. Residential and commercial property in southern region will continue to experience oversupply and slow down in their new construction project. But Johor Bahru, the RTS system, right, and the reopening of causeway for Singapore and Malaysia is a timely growth catalyst for this region. Yep. Okay, let's dive in for the residential properties, residential segment. Pandemic has spurred demand, right, for residential property in suburban areas. And now new home buyers are keen to look for landed houses projects in the areas such as Kuala Selangor, Kajang, Sepang Puchong, Puchang Alam, right, which offer affordable price at the same time have good connectivity to KL. While most young working adults, they are still prefer to stay within the same cities they goes to work. So KPKT, or our Ministry of Housing Local Government, is looking for options to include this affordable housing into their city planning. So it will apply similar concept of transit-oriented development and TOD seen in mixed development project into this affordable housing planning. This year will be challenging for the home buyer as there is no sign of extension for the home ownership campaign, HOC, and also residential sector expected to shrink a bit due to increase of the overnight policy rate towards the second semester 2022. However, there are initiatives taken by both government agency and property developer, like Rumah Idaman Housing, to help out with B40 group, and also private home ownership campaign from private developers. And these are the highlighted projects that going to start in already commenced and expected to commence in the second semester. Moving next is industrial segment. Industrial project, as expected, will see strong growth when the economy get back into full swing. So with the national push on Industrial Revolution 4.0, we will be able to see more industrial projects moving into kind of smart factory and warehouse system. And there will be more investment pumped into key industrial parks in northern regions such as Kulim and also Seberang Perai. Yeah, from the some highlighted projects, especially E&E sectors, E&E and manufacturing sectors, right? Malaysia is becoming a hub actually to produce microchips, semiconductors to support these global supply chain needs for the microchips, like for the electrical vehicles and other parts like computers, smartphones, devices. All these need semiconductors and chips. Yeah. Next will be retail segment. Restriction lifted and vaccination rate increase definitely speed up the recovery in the wholesale and retail trade sectors, right? And retail outlets there is some shift of the dynamic here. There are retail outlets in smaller suburban malls. They shows a trend in declining because preference has shifted to smaller units and also online operation. So they are more comfortable to do it online, and that will save their renters. But on the other side of the coin, more online brands are looking to have a physical store in major shopping mall in the cities. Successful online brands, they felt there is a need, to boosting up their brands, physical stores that give, stronger marketing into their brands. So this is how, this is the trend now. And we also see that, in the pictures there, I put Mr. DIY. So Mr. DIY is also a local brand which has successfully opened during this year, right? Their Mid Valley branch is the biggest store, I think, for now. Yeah, and some selected project highlight for this category as well. Office segment. Most workplace has already practiced hybrid working mode, right? I think most of your company also, okay, have the trend is moving in this trend lah. So there is a trend in a way that they reduce the space requirement, but encourage the right sizing and space consolidation for new office development. So the office operator now are diversifying, and they exploit for new market niche in order to accommodate for different size of business and organizations. Having said that, workspace is also refurbished, okay, to create this to engage at the same time, keep a balance between work. Office is a place for you to getting face time with your colleagues and also your manager. with border reopening, we see more light on hospitality sectors. And Malaysia will expect more than 4 million foreign tourists this year. And some of the travel restrictions have been lifted, like tourists no longer required to undergo pre-departures and on-arrival COVID tests. And travel insurance will also not be a prerequisite for foreigner entering the country. And we can see major hotel chains like Hyatt, Marriott's International will have new addition of their hotel brands in tourism hotspot, such as Langkawi, Kota Kinabalu, and in KL City Landscape. Some of the highlight projects include hospitality project, which is under design and documentation stage. And the realization of the construction will be in a period from second semester this year until 2023 onwards. Okay. So moving next, we'll be going through briefly on civil construction comments from the period 2019 to 2022. The economic catalyst will still be this infrastructure project. It will be the ongoing construction of large-scale infrastructure projects like MRT3. Tenders for the project management consultant has been advertised and already closed. And there are several main contractor package has completed as well and expected to be awarded around fourth quarter this year. Also, we have East Coast Rail Link. The project started in 2018, but the subcontracts for the construction of this rail link are still ongoing. Estimated every quarter and bi-monthly they will award some of the packages. Current completion rate is at 29%. This is from the Malaysia Rail Link report. And excavation work for their longest tunnel called Genting Tunnel has begun on June. The tunnel work will take 2 to 3 years to complete. We categorize civil construction projects into two main categories: infrastructure transport in one category and utilities. So these are expected to be dominated by infrastructure and transport. This year we see that the value is USD 4.95 billion, or 72% of the total civil constructions value. Some of the selected project, and we're moving next to show you the civil constructions started in this year according to the region. So as you can see, East Coast like Terengganu, Kelantan have recorded nearly 2 billion USD for the civil construction commenced in first semester 2022. And the major infrastructure projects include Central Spine Road, which is a highway connecting Kelantan, Pahang, Negeri Sembilan, these three states. And we have Lebuh Raya Kota Baru, Kuala Krai at the same time is also a big project, and a hydroelectric dam projects in Nenggiri. Northern region, such as Kedah and Perak, has been going strong with solar project in recent 2 years. There's about 65%. The reason LSS4, the large-scale solar photovoltaic plant, are being implemented in these two states. The location include Kuala Muda, Gopeng, Batang, Padang, Bukit Selambau, and Kerian, and other locations in the states. And Central Region and East Malaysia also expecting a surge civil project to be implementing around second semester 2022. These projects include the early work for MRT3 and ongoing Pan-Borneo Highway to connect Sabah, Sarawak, Brunei, and Kalimantan. Right. So the outlook beyond second semester 2022 for the construction industry. A property market will remain upbeat in the coming semester. Although news on upcoming general election may cause some speculation on market volatility, an SME company may have to navigate a risk before venture into any contracts. While construction sector will be continually supported by introduction of large infrastructure project, example the revival of MRT3 and ongoing infrastructure in the East Malaysia. Border economic boost. Yeah, as Indonesian new capital IKN is going ahead as planned, it will boost the border economy due to the rising demand for construction service and building products in the region. So with this strategic location, East Malaysia can be the hub to cater for manufacturing and building material supply needs across the border. Overall, the demand on commercial and residential property market are gradually returned, and investors have more confidence in current market. That brings us back to the presentation today, opportunity search in building segment. Thank you for your time in my presentation. If you have any questions, I'll be delighted to answer. Thank you. Over to you, Suraya.
All right, thank you, Frank, for your presentation. So moving on to the endemic phase, I believe we're all eager to engage with the key market players, aren't we? Now, at BCI, we have various events lined up, including the upcoming Top 10 Awards by the BCI Central. This is an avenue for formal networking with elite architecture firms, property developers, manufacturers, and service providers alike. We'll play a short clip right now. The BCI Asia Awards 2022 is happening on the 26th of August at the Mandarin Oriental Hotel, Kuala Lumpur. If you're looking for events and network opportunities for your business, kindly contact Mr. Jason Au, Business Development Manager of BCI Central Malaysia, with his contact shown on screen right now. All right, ladies and gentlemen, we have come to our final session of the day. But before we begin, we would like to play a short video from SP Setia Berhad. All right, we have with us today Datuk Zaini Yusoff, Executive Vice President of SP Setia and EXCO member of REHDA Malaysia, to share with you about the next normal in property sector. Let us welcome Datuk Zaini Yusoff.
Okay. Thank you very much, Suraya, and laying just now for the opening address and also kind introduction. My fellow learned speaker just now, Dr. Sailesh, who talked to us on the overall financial outlook in the region, and Mr. Richard Baker from PwC Malaysia, who speak to us on the ESG initiatives. Mr. Frank Chow, and our participants today from various industries for today's webinar. I would like to say that I will be the last presenter, saving the best for last. Okay. Firstly, I would like to thank BCI Central for inviting me to share some insights about Malaysian construction mid-year market update. Today, I'm going to share something that is very close to my heart because I've been in the industry for more than 34 years. That is the next normal in property sector, particularly on how developers respond to the market in this recovery stage based on current economic situation and construction market, especially after the pandemic. So what happened was, we hear from Dr. Sailesh just now, despite the negativity in the market and all the doom and gloom, I think based on the presenter and based on Frank also just now mentioned that there are lights at the end of the tunnel. I think most of the results are mostly elevated for the remaining of this year and also next year. So the pandemic actually has affected everyone's livelihood, behavior, perception of life, education, economy, and the way that we are doing business. I think COVID-19 started as a health crisis which quickly evolved into a global economic crisis at a speed and magnitude that we have not seen in our lifetime. I think the ripple effect are still unfolding on a global scale, and it is unlikely that the true impact of the pandemic can be measured until the situation stabilizes. Now that the pandemic has become endemic, we can see some enduring changes, especially at the individual, organizational, and government levels. Especially matters involving policy and SOP, dealing with the new norms. I think we have to accept that we have to live in the new norms. Like what Frank mentioned just now, there's a lot of ESG initiatives by a lot of organizations and companies that shows that we care towards our Mother Earth. And somehow or other, we are evolving the way that we are doing business, including the ESG agenda. As for the housing industry, we really have to study and suit the current market trend and proceed with the changes, including replanning work. Sometimes we really have to, as a developer, we have to look at our master layout plan. Because of the new norms, we have to revamp the whole thing and to suit the current market demand. So those who responded quickly and adapt to the changes will capture the majority of the demand, as competition is very stiff. I think a lot of developers as well as contractors during the pandemic has closed down business, but those who responded well can really capture the market and move forward. Okay, next. Let me share with you my first slides, which I got it from DOSM, the Department of Statistics Malaysia. The construction sector contracted at a smaller pace of about minus 6.2% in first quarter of 2022 as compared to negative 12.2% in fourth quarter of 2021. In other words, market has improved, especially for services and construction subsector in quarter one 2022. Progress in new and existing commercial and industrial projects continue to support activity in the non-residential subsector. Growth in the civil engineering and residential subsectors improved but remain subdued, particularly due to the uncertainty of our political scenario in the country. So value of construction work done is about 29.5 billion in first quarter of 2022, comprising majority from private sector, about 17.9 billion, while public sector share is about 11.6 billion. Next. Okay, during the pandemic, some of the issues that were faced by the developer are as follows. Firstly, COVID-19 has really impacted massive impact on construction projects. There's a lot of legal implications varying from projects to projects and contract to contract. As you can see, also there's a lot of cases like Ang Ming Lee case, Blue Dream development, you name it. I think there's a list of cases that is still ongoing due to the pandemic. So delay in supply chain, which resulted in delay in developers' completion deadline, immediate impact of cash flow and financial losses, because we still have to pay salaries and during the MCO, despite not generating any revenues. Now during endemic period, the industry have to make up for the higher productivity to complete the projects undertaken, although sometimes the developer have to cut or reduce the profit margin, or maybe up to break even sometimes. And not to mention some of the building material supply chains have suspended production and distribution due to the increasing costs for imported raw materials. And there's a lot of limitation on transportation, and also travel ban have really slowed down project delivery and equipment manufacturers. And as far as the labor shortages is concerned, it is the problem still persists until now. I think with the current policy, it really doesn't help the industry. So hopefully, a government can do something about bringing in the workers. I think last week, I think the ministry did mention that they have already sorted out the difference with Indonesia, resulting in contractor and developer able to apply for foreign workers from Indonesia already. And last but not least is the construction investor exposed to the impact of the COVID-19 outbreak as delay in completion, and it will be jeopardizing the project profitability. Next. Okay, over the years, property has been a major contributor to Malaysian economy. It plays an important role by providing major employment, especially to about 180 or more industries which are related directly with property development industries. Construction sector, on the other hand, also employs about 1.4 million workers with a salary of about 40 billion yearly. It forms a significant portfolio of the financial institution direction, including SME sectors involving developers, contractors, suppliers, and other services. As far as the national agenda is concerned on the home ownership policies, especially involving majority of rakyat, especially the one in B40 and M40 group. I think Frank did mention about HOC not being a standard. True enough, you know, it was until last year, but I think in the recent home ownership program by the government, I think PM has already announced in July that they are giving for property for first home buyer from up to 500,000, they're giving 100% stamp duty waiver until end of 2023. And from 500,000 to about 1 million, they're giving 50% discount for the stamp duties for the same period as well. Next. Okay, in the study by NAPIC, the property market performance recorded a slight improvement in 2021, but has yet to surpass the pre-pandemic level recorded prior to 2020. In 2021, there were about 145 billion transactions recorded. The residential, commercial, industrial subsector recorded an increase in volume of transaction, while agriculture and development lands recorded a decline in transaction. Next. Okay, under the market highlight, there is an upward trend for Malaysian house price index from 2010 to 2021, but the annual changes has slowed down for the past 4 years. If you want to compare the index for house type, terrace, semi-detached, and bungalow, recorded the decline in the average. This is mainly due to most developers in Q1 dispose their properties by giving a rebate or discount for cash flow purposes. Some even cut the profit margin to a bare minimum. Actually, if you were to ask me, now is the best time to purchase a property, because moving forward, the prices will definitely escalate, and you may get a smaller build-up or lower specifications in order to curb the price increase. So developer will have to opt for, you know, smaller build-up just to match the price. Next. Okay, under residential market highlights from 2017 to 2021. In 2021, there are about 22,000 units unsold and not constructed, while 70,000 units unsold and under construction. It relates back to the earlier slides confirming why developers are giving discount and rebate to clear off unsold stock for cash flow purposes. Next. Okay, residential overhang by state, especially Selangor, Johor, Penang, and Wilayah are leading the numbers in residential overhang. Majority of the overhang properties by type is high-rise apartments and also condo, not to mention service apartment, which falls under commercial type, which has more than 24,000 overhang. Next. Okay, REHDA did a biannual survey conducted among about 124 respondents in April 2022. And I think overall, 40 respondents launched their projects in second half of 2021. I think some of the launch unit also decreased by 8%, while sales performance increased by 11%, 11 percentage point. And majority of the launches were dominated by residential properties, especially landed property. Let me just share some, we in Bandar Kinrara, one of our Setia projects, we did launch our terrace houses. We only have about 42 units altogether, but when we are selling is a 22 by 75 footer units, and there are about 5,000 over registrants actually, and 800 over came with the checks. So we had to do some balloting. So you can see market is coming back, especially the one that can really suit the demand of the buyer. So a lot of buyers, they're looking for landed properties, and we had no problem selling the one between 700 to 800. But in Bandar Kinrara, it's special because we sold that property for about 1.27 million, and it's with an overwhelming response. Next. Okay, most launch, as I mentioned, I think 51 respondents mentioned that they launched in the first half of 2022, and the price is between 250 to 500,000, and it goes way to about 700,000. So that is the most popular products. And top reason for not launching in the first half of 2022 actually is unfavorable market demand. But it comes to second half of 2022, there's a lot of developers they're launching already. And also 26% responded because of the affected by COVID-19. Next. Okay, as far as the optimism is concerned, most of the developers are optimistic in all categories: economy, business prospect, and purchasing power in second half as compared to first half of 2022. I think with the opening up of the border and also lifting of ban in traveling, you can see that people start spending, especially if you go to the mall now, you can see hundreds, and it's very difficult to get the car park. So I live near the Pavilion 2. During weekends, you can see a lot of people go for shopping, and they are spending their money probably from the saving during pandemic. Next. Okay. Okay, this sum up the one that I mentioned just now. Some highlights: a number of units launched have decreased, while sales performance have increased. And then secondly, 2-story and 3-story terrace dominated the most launched and sold properties. Commercial properties have reduced significantly. And then the respondent mostly neutral in the market for first half, but more optimistic in the second half of this year. Then majority of aging unsold stocks were more than 2 years old, held by 64% of the respondent. Then among the top reasons cited by respondent is because of unfavorable market condition and also affected by COVID-19. Next. Okay, it is next. It is very obvious that there are shifts in buyers' preference. The pandemic has shifted buyers' preference for residential property, changing work styles. There is more of work from home, has led to change of home design to suit evolving home buyers to work from home. Subject to affordability, buyers prefer landed property as compared to strata development for additional space, better ventilation, and natural lighting. High-speed internet also is a must, together with the requirements for smart homes. Next. Okay, a lot of companies still practices hybrid concept, whereby it is a combination of physical and also work from home. A study was made by Job Street indicates that majority still prefer to continue working from home, but that one is for employee. But I think employer prefers to work from the office, I think because of many reasons. And currently there is a widespread of flexible in terms of work from home, making more demands for technology for on-site and in the home office. So market is shifting towards digital. I think work can also life balance. Next. Okay, these are some new requirements by purchaser. Before the pre-pandemic, properties are more focused on big aspects such as price, tenure, location, developer track record. But after the pandemic, I think post-pandemic, as people spend longer hours at home, more homeowners will plan on maximizing, improving the use of every square inch of their boats to ensure they appreciate the extended hours. So we really have to, to satisfy this, to create more variety of spatial experience, creating more bright, open rooms, then usage of flexible furnitures, design of for cleanliness, because people are very concerned about cleanliness nowadays, to introduce air purification system that is among all the new requirements by the purchaser. Next. Okay, throughout the time, the primary function of home has been safety and well-being of the occupants. But today, I think during the post-pandemic, the houses needs to be more versatile and ready for quick conversion into an instant home office or virtual classroom, because you need to work from home. So, there's a lot of spaces that really need to be convertible. And in terms of design, it has to accommodate the elderly, special need individuals, especially if you were infected by COVID-19, quarantine. So there's special spaces that need to be converted straight away. Next. Okay, some quick facts on the pre and post pandemic. In terms of location, pre-pandemic, people prefers to stay within a short distance to mall, F&B and commercial center. As what mentioned by Frank also just now, people don't mind going out, to suburban areas if it suits their purpose, because further from city, higher demands for landed houses, good connectivity, affordable prices, ideal living spaces, which are larger, so that they can convert to a more functional spaces. And then under the preference trend, pricing and freebies, definitely, as I mentioned, good internet connectivity is a must. High demand for better improved infrastructure, and also the delivery service. People are ordering foods, to home. Then more bedrooms, especially to accommodate the work from home situation. Next. So these are some of the initiatives during the pandemic. We have our Setia Visual Acts, whereby we providing end-to-end solutions. So during the pandemic, we still deliver our revenue last year. In fact, we did a lot better. Also, we did deliver about 4.1 billion in terms of revenue to achieve our sales target last year, despite of the pandemic. But mostly sales are done via online. So we really have to capture on that market. I believe a lot of developers are doing that also. Next. Okay, some of the things that we have to do actually is value engineering. In order to have a less dependency on foreign workers, we really have to opt for precast panel, IBS, and also BIM. So the use of standard design and cost buildability with basic facilities, compact sizes, functional design to keep the cost down. So I believe like the likes of CIDB, they're doing this standard design, especially for the affordable homes, in order to minimize the costs. So currently, as we all know that cement, steel bar, timber, has already increased in price. So we really have to opt for this precast panel in order to reduce costs. Next. Okay, the future of construction industries will be highly dependent on the adaptation of the new technology and innovation. Adoption of new technologies, new innovative method also will shift in how building and infrastructure projects are being delivered. So there's a lot of infrastructure projects being planned, and hopefully it will connect all the locations, and everybody will feel that it is near, although it is a bit further. Project will not solely focus on better performance building and infrastructure, but also improving quality of life for society. So this is more on ESG initiatives. I think a lot of companies are moving towards ESG agenda, and we have to do that for the love of our Mother Earth. Okay, the demand of projects are predicted to become more complex and interconnected. The construction industry should now leverage on new technologies to deliver better value. Okay, I will end my presentation by saying, don't be afraid of changes. All of our dreams will come true if we have the courage to pursue them. Thank you so much. Thank you.
Excellent. Thank you so much, Datuk. Thank you, Datuk, for your in-depth presentation. Now, Datuk, if you can stay on for a bit, we have the Q&A session right now.
Right.
And I would also like to call upon Mr. Baker and Frank to come on screen as well for a collective Q&A session right now. All right, perhaps we can start off first. Okay, since Datuk, maybe we start off with you. There's a question that comes from Derek Ong. And Derek would like to know, how do you see the number of construction works in the near future? And will it stay stagnant, reduce, or rise? Datuk?
Okay, thank you very much, Derek, for the question. So currently, a lot of construction works, I think a lot of contractors, they are having difficulty to complete the jobs because of the shortage in foreign workers, and as a developer also, I'm facing, a lot of developers are facing potential non-deliverables to the purchaser in terms of timing. So what we'll do currently, a lot of projects, contractors going to finish up the current projects, and in the near future, I think in terms of construction works, it will definitely increase, but maybe the increment will be next year. This year it will be stagnant, whereby a lot of people will be completing the one and hand over to the purchaser. So, but moving forward, I think by next year, probably by second half, definitely there will be more construction works, because as far as developers is concerned, we really have to deliver the numbers, especially the one with the public listed, company. Thank you.
All right. Thank you so much, Datuk. All right, the next question goes out to Mr. Baker. And the question goes, even with incentives, why are there not many developers not being part of green initiatives? Mr. Baker?
Yeah, I think it goes back to my point before about the cost versus benefit, right? So sometimes
Right.
with a lot of this new technology, the early adopters, you have to be there to do all the snagging and do all the little niggles that new projects have, right? So sometimes construction is a very, I would say, old school industry. We are a little bit slow to react sometimes,
Right.
a little bit reluctant to change sometimes as well. And so that could be one. So the incentives are there. To be perfectly honest with you, they are not as extensive as perhaps we would like, but it's something that it needs to be something to incentivize or something to force people to do it, because generally it will come down to cost, unfortunately. And at the moment, the costs are not quite balancing up. So I think that's one of the main reasons why we see a lack of adoption. Constructability, does it actually work technology-wise? And also the cost of it as well.
Excellent. Thank you so much, Mr. Baker. Right, the next question goes out to Frank. So Frank, what kind of retail projects are more in trend for the second half of 2022? Is it shop lots, shopping malls, data center? Is it in the pipeline for this year? Frank?
Thanks, Suraya. Okay. So what is in the trend, right? Shopping mall. Yeah, shopping malls will be still uptrend for the cities because they are transit-oriented developments. So this mixed development will include convenience for shops, like the one we have BBCC, right? The first launch is Lala Pots. So there will be in our record there will be upcoming few malls in KL, Johor as well, Penang. Yeah, most of the major cities will be welcoming the shopping mall. While on the suburban area, we'll see some rise on the community kind of like shop office, more to shops and offices buildings. For the data centers, yeah, I think data center is still in like in the Kulai Sedana Center, this Sedana area, right? They are building this hyperscale data center. Part of the quite of the areas are used to build up these data centers, which to support business services and social medias. But one thing I want to say for data center is in a sense need to balance up because it actually drawn a lot of electrical powers. So like Sedana have done a quite strategic because they were considered, at that time Singapore have a moratorium for the data center because it actually too many data center in Singapore crowded up and crammed their electrical grid. That's why they post some limitations on that. So if Malaysia would want to build data center, they need some areas to really kind of like cater for this need to balance up, increase the national grid and be more choosy on the scale of data centers and the size and things. I think this is a trending developments. Data center, it will keep coming. The investment, what I see from like for example the first one in Johor, the Chin Data, already built few of the data centers in Malaysia. Thank you, Suraya. I hope I answered the questions.
All right. Unfortunately, we're running out of time, but there's one last question, and I'll open this to the floor. All right. So to all the panels. All right, and this one comes from Y Leong Chin, and he asks, how does mega project in shifting the capital city of Indonesia may bring the impact to supply of labor to Malaysia's construction sector? Maybe Datuk wants to.
Yeah, maybe I'll start.
Yeah.
You know, our neighbors are doing better than us. So, but hopefully, you know, I think a lot of now we're having difficulty in getting the foreign workers because most of the workers, when they go back to Indonesia, then they are being better paid there actually. And now, as you can see, if you are in the construction industry, to get a foreign labor now, last time used to be about 90 ringgit per worker per day. And now they are very demanding. You have to be about 150, 160 ringgit. It's almost double demand, and a lot of pinching of workers happening from one project to another. So we really have to tackle this issue in terms of foreign laborers. You know, bringing in foreign laborers, especially from Indonesia or other countries, you know, like Bangladesh or Pakistan.
Right.
Because I think it's more towards the government have to change the policy in order to bring the workers back. We really need the workers actually.
Right. Okay.
Thank you.
All right. So unfortunately, we did have a lot of questions coming in, but it's already nearly 4:30. And whatever questions that came in, what we'll do is we'll respond to the rest of the questions via email.
Okay.
All right, next up.
Yes.
All right, next up, we have the lucky draw session, right? So here we have the list of names for those who submitted questions. Let's see who the first winner is. ST. Congratulations, ST. Yep. All right, thank you. Let's see who is the lucky winner number 2. Kin Man Fong, congratulations. And last but not least, is it a Mr. Jet Tan? Congratulations all. All right, you will be contacted via email on your prize redemption. So enjoy your movie vouchers. All right, we hope that everyone have enjoyed the webinar as much as we did. And we look forward to see you at our next event, presenting to you the Equinox Kuala Lumpur. The BCI Equinox is a boutique cocktail and networking exhibition for suppliers and manufacturers to showcase their products and services to architectural and design professionals. The BCI Equinox Kuala Lumpur is happening on the 22nd of November 2022 at Mandarin Oriental Kuala Lumpur. And to know more, kindly contact Mr. Jason Au, Business Development Manager of BCI Central Malaysia, with his contact shown on screen right now. All right, last but not least, we will appreciate your feedback on this webinar. So do scan the QR code to leave us your thoughts on the event today. The QR code is now on the screen and in the chat box as well. All right, with this marks the end of the presentation for today. And before we say goodbye, we would like to say thank you once again to all of our speakers for making time with us today. Thank you to the audience as well for joining us. We look forward to seeing you again in our events and at the next webinar. Until then, have a pleasant evening ahead. Thank you.